From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 27th. You're listening to the Macrocast. This is Tony Fratto coming to you from New York City this week. Of Brendan Walsh and John Fagan in the Washington, D.C. metropolitan area, and John Dick of CivicScience with us. The HPS Macrocast brought to you by Markets Policy Partners and Hamilton Place Strategies. John, we've been paying attention to the earnings coming in from a lot of the consumer-facing retail companies over the last couple of weeks. Have been kind of whipsawing the market. The market's up, up this week. Might have a one of the rare up markets at the if we fingers crossed with how things close today. But the kinds of stocks we've been looking for that have been whipsawing the market. We talked a little bit about this last week with Home Depot and Lowe's and Walmart, Target. We've seen some of those, some other stocks this week, including some of the dollar stores. Big Lots reported today, and I think there's people are trying to sort out where consumers are going. First, how strong is the consumer? What are its resources? How are they feeling about things? And then what are they actually doing? And what does that mean for earnings for so many of these companies? And we had our the CivicScience HPS Economic Sentiment Index out this week. What are you seeing? What did the ESI tell us? And what are you seeing in your data?
Obviously, consumer confidence isn't great. We had another record low. We're in uncharted territories here, almost, over 10 years of us doing this index together, Tony, and we keep seeing new bottoms. And the question is like, how far can it go down? Because we're already like in unprecedented territory. But, if there's any sort of silver lining, if you can call it that, is that consumers' confidence in their personal finances is still strong, relatively strong. That's sort of buoying a little bit of the rest of the metrics we gather are a lot more sort of forward looking around attitudes toward the housing market, terrible. Attitudes toward major purchases, not great. Attitudes toward the job market are softening, and certainly overall economic outlook isn't great. But when asked about their current personal financial situations, consumers are still pretty solid. 75% of U.S. adults say that they are still equal to and or better off financially than they were before the pandemic. And that's helping to sort of float some of the retail spending numbers that we're seeing.
Yeah, it's kind of amazing. The thing I think that we kind of still, keep seeing is that there's no question that inflation is having an impact. It is dampening some purchasing, but not by as much as you would think. With 8% inflation, you would think that it would have a much bigger impact. But consumers are actually holding up really well. And again, I know we keep coming back to this, but we keep talking about the fact that consumers do have money and they have jobs. At almost like maybe still one of the best job markets ever, and so they can get jobs and they can get pay increases. We just saw Apple following some of the other technology companies with raising wages. A lot of companies are raising wages to retain and attract workers, and but still, boy, overall, they just feel like things are really, really not going in the right direction. Now, John and Brendan, I don't know if there's we pay attention to ESI for lots of reasons. We do live in not just a market economy, but a political economy. And I do think it matters quite a bit for a lot of different reasons. And but we don't necessarily see, much correlation between people being, because of what John just noted, right? People can be pretty upset and they still go out and spend if their household finance situation is still good. So, the sour mood, is it having an impact at all? Anything that you guys can see?
I think overall, on sentiment, the consumer is angry, but then Well, like Brian Moynihan, who is the CEO of Bank of America, which has like 20% of all of our, checking and savings accounts, says the consumer is incredibly strong. They still haven't spent down their stimulus checks, and everyone has a job. And what you're seeing is a rotation in terms of what they're spending on. And they're annoyed that the gas prices and food prices are higher, but that's not stopping them from going out and enjoying life. The airlines are overwhelmed for the demand for this summer. 90% of Americans are planning on traveling in the next 3 months. So I think you do have a bit of a disconnect in terms of how people feel about say that they feel and how they're acting. You also had a stock market that in 2021 was up 30-40%. It was kind of bubble territory, and now we're correcting. And also within that correction, you're having a rotation of we stayed at home for 2 years and we bought goods and they had them delivered to us. Yeah. And I guess the market kind of priced in that the Apples and the Amazons of the world and the Pelotons of the world, we're gonna have this as the new normal. And it's not the new normal. We're going back to the old normal. And now people are have bought all the technology stuff that they need for a couple of years, and now they're going to Miami and out to a fancy restaurant. And
I feel like
also rotation in stocks.
Yeah, I feel like I'll take any kind of normal.
Me too. Yeah.
New normal, old normal. If it's normal, I'm a buyer. Like I want anything that feels like just any kind of regularity and predictability that we could have. I'd like to hang on to that and lash myself to that mask, because I don't know it's hard to say what that is anymore, right? I mean, it makes perfect sense.
I agree. Yeah.
There's also a lot of dynamism around that too. So we all go out and say, well, look, obviously what's happening here, because of what we learned 2 years ago, what's happening here is, people are, they're rotating out of the goods and into services, and it's a good thing. But there's so much dynamism around how that happens. I mean, it's just like take airlines, for example, right? It's true that all the airlines are full and prices are spiking. And, I just bought tickets for vacation, and I'd waited a day because I was thinking about it a little bit more about the dates. And I went back and checked again, and the prices were up, and I just bought them. I'm not going to perfect my dates. I'm just going to grab these tickets right now because seats were going away. Well, for the airlines, imagine the problem airlines are confronting today is that we have this rotation. We have consumers who want to get out and move around. They're in a vacation season. But airlines have taken a lot of airplanes off, right? They're out in the desert.
Exactly.
Airplanes are sitting out in the desert, not flying, not ready to fly quickly, right? It takes a little bit of time to get them up to speed. So for an airline to bring an airplane, add capacity now, that sounds like the right thing to do. We've got all this demand, prices are spiking, people are shifting from goods to wanting to get out and go to Disney World or wherever it is that they're going. And so we need airplanes to fly them there. At the same time, we've got people out there saying, hey, recession is all but certain in 2023.
Yep.
Well, how do you do this? Why would you do that if you're an airline? Bring, more capacity online when you've got other smart people out there saying, recession is coming. And I
suppose it's the same with oil producers.
Yeah,
why
exactly.
should we massively ramp up oil production if we're going into recession?
And that's a really
to run a business today is what I'm trying to say. Yeah.
Yeah. You're 100% right.
Yeah. I mean, touching on that, Tony, that's a key point. And when you look at the way in which financial markets have reacted to the retailer earnings, it's important to keep in mind that the strength of the consumer is really only one factor. And the things that you're talking about, supply chain management, the ways in which they, run their businesses, management is reacting to these. And plus expectations is a really massive factor. So if you were to just look at the way that, retail stocks have surged one day and collapsed the next and gone crazy, you'd think, nobody has any sort of read on where the consumers are, but it really has a lot to do with the way that these companies are managing these issues in different ways, and how, versus the expectations that investors had for them. So yeah, we are seeing, financial markets in a bit of a transition period. We think the downbeat dynamics earlier this year, where as stock markets have corrected pretty sharply, the Treasury yields surged higher, and as the Fed got more aggressive, we saw that really across the yield curve in the Treasury market, and we saw the dollar jumping northward. But these are pricing in a very aggressive Fed posture that may not be compatible with the kind of more balanced risks that investors are now seeing on the horizon, where some parts of growth, maybe the consumer is kind of hanging tough, but you definitely see softening in the housing market, and you see signals of future softness and guidance. And we got some data this morning that didn't look quite as scary, perhaps, on the inflation front. And we heard Atlanta Fed President Bostic, who's really been ahead of the curve, ahead of his colleagues in sort of looking at where policy and fundamentals meet, talking about a pause of the tightening cycle of rate hikes in September. And that really wasn't in the markets until this week. So we got a little bit of a respite this week. I think a much needed one, a much appreciated one going into the long weekend, where markets have dialed down some of the intensity. And there's a sense that perhaps we're getting into a more balanced equilibrium, at least from the market's perspective.
But John, also go a little deeper in terms of the treasury market, especially the part of the treasury market that kind of predicts what inflation is going to do, because we focus a lot on what the consumer is saying, inflation's terrible, and then on earnings and Apple's being squeezed. But the 5 year forward, maybe explain what that is and what that's been doing recently.
Yeah, I mean, there are lots of different ways in which markets reflect inflation expectations. And the classics are the break-evens, 5 year, as you said, 5 year forward inflation swaps. These are ways in which investors, bet on where medium to longer term inflation trends are going. And when you look at kind of the classics, the Treasury, the TIPS break-evens, the inflation protected Treasuries break-even rates for inflation, the 5 and the 10 topped out in March and April, respectively, at 3.73 and 3.03%. Those are pretty high. And now the 5 years trading under 3%, 2.97%, and the 10 years at 2.63%. These are not scary, and these have come off dramatically. These aren't that scary in terms of you could even characterize that 10-year break-even rate as pretty much compatible with the Fed's current inflation targeting mandate, which is around 2%, but with pretty wide corridor on both sides, obviously. So this is it. There are lots of mixed messages on inflation, and it's right now, although we're seeing it very much in the headlines, markets are looking ahead and looking down the road, that forward-leaning posture, and seeing a relatively more sanguine picture.
Do you think, John asked you this as well, especially, so look, our presumption is that things like, summer travel are holding up. The airlines certainly are doing well, but are you seeing anything like, any scaling back at all, because of prices, or gas prices have not peaked yet? It seems like, and are you seeing anything of people indicating that they could be pulling back a little bit from travel?
Well, I mean, so this is, you talked about dynamism. This is another degree of that. So let's just remember, yes, the overall consumer is strong, but we've got these bifurcated groups of haves and have-nots right now, and they are behaving differently. A lot at the upper end of the income spectrum, people are just paying more for things. They're not buying more items. The reason retail is up is we're just spending more on the things that we buy. Mm-hmm. You move your way downstream from there, and it changes a bit. So we are seeing some reticence or rethinking of summer travel among sort of the middle to lower end spectrum income groups. And, that's expressed intent. We haven't seen the actual behavior change yet, but the consumer is saying their plans this summer are sort of wishy-washy. So we'll ask me in August or September, but there is an apparent softening among sort of let's just call it the bottom half of the income spectrum right now. The other thing that is important isn't, so yes, the consumer is strong, but they're also changing other behaviors as well. They're moving downstream in certain retail categories. So we're seeing, people moving down to dollar store discount shopping. We're seeing a huge surge in like private label brands at grocery retailers, right? So consumers are finding ways to adapt to the circumstances. They're still maybe spending the same amount of money or even a little bit more, but they're spending it in different places in a different way.
We are being down in DC. Obviously, you see things through the political lens. It's just in the atmosphere down here, and we're getting into the midterms. It's something we've talked about before, John, that bifurcation along political lines of the way your survey respondents see the economy playing out. Are you seeing a similar gap? They're obviously, the messaging from Republicans, and they've got a pretty large megaphone, is very downbeat about the economy, as one would expect.
Yeah, I mean, and you can see that in regional numbers. You can see that in rural versus urban. Obviously, the sort of the right-leaning population areas are spending differently than the left-leaning population areas. A lot of this is just sort of this expression of hope and fear, born of the confidence or lack thereof they have in Washington to fix these problems. So yeah, there is absolutely that political underpinning there. And the question I've just had all along is, how much are we all just talking ourselves into this versus, right? Is it real, or are we sort of fearing ahead of reality and cutting back in advance of something that hasn't happened yet? I don't think we know the answer to that just yet.
John, are there, and John and Brendan, are there anything else that you're that you're going to be looking for? We're kind of at the tail end here on earnings, right? But anything else that you're looking for that the market might be telling us? Anything to take from, this week, where, is it a false sunrise, where, maybe we've seen a bottom, or you still think there's more bottom to go?
We shifted for our clients. We shifted neutral on stocks last week, and we'd been very negative downbeat on stocks since the fourth quarter of last year, on our general macro call. And for the reasons really being, as we discussed, the potential shift in tone from the Fed that we're seeing. And we're seeing, it's not just the Fed. When you look around the world at central banks, there's a lot of more balanced rhetoric. The European Central Bank has been more balanced since the beginning. They're probably going to be getting into the rate hike business here pretty soon, but in a very cautious way. And they have highlighted the downside economic risks. Obviously, Bank of Japan, the People's Bank of China, and Beijing are getting into the stimulus game in a more serious way here. We saw this week was kind of a turning point, it seemed, in terms of China's more muscular rhetoric, coming up with specific kind of economic support rather than just kind of jawboning in hot air. The People's Bank of China cut a key interest rate, and it followed up with Premier Li outlining, I think 33, was it, Brendan? 33 different economic support metrics, and that sort of thing. Alibaba came out with earnings this week and said, hey, it seems like the government is realizing the damage they've done to us and maybe is giving us a little bit of leeway here. Their results weren't as bad as people expected. These stocks have come down just enormously off the highs. And this is a change in tone. We don't necessarily know if this is, we're not necessarily calling a bottom or anything like that.
I'm calling a bottom, John.
Yeah. One good sign from this week. No,
to be clear, I called a bottom about 2 weeks ago.
Yeah. But you weren't that far off.
And I still feel
I think we have found a bottom, because this week, the volumes, the amount of stocks traded was much lower. So usually in a bear market, anytime the market tries to rally, the people use that rally to sell more shares, and that hasn't happened this year. So I think we're somewhat reaching a point where everyone has sold everything that they can sell.
Yeah, well,
and we can find a bottom.
Yeah, Brandon, I think that's right. I mean, but I mean, actually, you said that hasn't happened. I think it's happened, right? I think we went through that.
It happened this week. Yeah.
Yeah, just not this week. I mean, I think it's happened.
Yeah, it happened the last.
I think we're through
4 weeks. Really.
Sense, yeah, for what you just said and what John Fagan just said is why, like, I'm pretty optimistic for the second half of the year, actually. Right?
Like, we are too. We're very optimistic for the second half of the year. I think inflation generally is coming off. The Fed is going to be less hawkish than was originally priced into the market. Remember, we talked about that. What the market price is for Fed is always way too hawkish. I think Bostic is a great example.
Right, Brendan?
Yeah.
Still 50 plus 50, right? I
think that's baked into the market. But then at that July meeting, they hike 50, and then they start to say, okay, maybe we're gonna in September we'll do maybe 25, or depending on what's going on, maybe they actually pause in September.
Yeah. I think that's right, and I think, like, I've been talking about China. I think the worst is over in China. Right. I mean, I think
knock on wood, especially with the lockdowns.
Yeah. I think the worst of the lockdowns are over. I think fiscal support and monetary support it's what we want. It's what they should be doing, is boosting. It helps us if China boosts
very much
growth. It's a good thing for the global economy. And so, Europe, I'm still worried about Europe, obviously, and I'm still worried about a whole lot of countries that are facing really challenging energy and food environments. Like, that is that really will be the big story the second half of the year. Especially food is going to be the biggest. Like I said, the biggest story of 2022 hasn't happened yet, but it's coming, and it's food. And so that's a big deal. But from a macro standpoint, and especially with respect to the U.S. economy and equities, I actually feel like things are. I do feel like it's up from here. I think everything that needed to pay a price for the rotation has paid that price. It's been pretty dramatic with pretty much every stock. Although I was kind of surprised by Big Lots today falling significantly. They're down 15%. It's almost 16% right now. Big Lots is down 16%. And I don't know why people weren't selling Big Lots like a week ago. Which they weren't, by the way.
Yeah. The idea that the market is fully, efficient and forward looking. When it comes to earnings, I think that debunks that theory.
Yeah, I don't really pay attention to Big Lots. I just happened to just because they were reporting, and I saw this chart, and I saw it's like a big fall off today, 16%. And I thought, why were people not selling it like a week ago after you saw everybody else? Like, what were people holding on to Big Lots for?
That was a question I was going to ask you guys, because you're far more the market experts than I am. Because when we look at this just from the lens of the consumer, none of this is particularly surprising. They all bought televisions over the last 2 years. They all bought big home goods. Like, they weren't going to continue to do that. Were people just oblivious to the fact that these comps were going to be down because last year and the year before were so unusual? Like, is that psychology, or was it just a big miss by everyone?
Well, I think the comps are actually up. Business, this is the thing, John, is like business is up, margins are down. And margins are down for two reasons. One is that in some cases they're getting squeezed, sellers are getting squeezed on inflation. And the other is just they got, is just an inventory story for them also getting, that they misanticipated the market. And so, but I think that's why I think like those are, margins are, that where their inflation impacted are, that's going to work itself out. I mean, like they've learned a couple things on and what they can do on pricing. And I think that's going to get, I just think those things are going to get better. But again, but people are going to stores and buying stuff. Like that is a fact.
No question. One thing I'll say about sharing your optimism for the second half of the year, with one caveat, is that we get inflation chilling in time for back to school, and certainly for the holiday retail season at the latest, right? If we start down the other side of this mountain through the summer, that's going to make a huge difference in spending, consumer spending and consumer health in the second half of the year. So that the timing is non-arbitrary in terms of how we get inflation under control.
Yeah, and that really is it is a big question. Seeing the way in which inflation is increasingly, it's narrowing to energy and food. And I guess the question in my mind, and Brendan and I have talked about this a lot, we'd always pictured 2022 as a year of two halves, the first half being very challenging and the second being more balanced, more positive, a little bit more reflationary as inflation comes off and growth concerns rise. But the Fed is reactive to that. Global central banks are reactive to that kind of cushion, and a recession does not materialize, and there's a relief in the back half of the year. Our question is, beyond that, once the Fed restarts the hiking cycle at the end of the year, inflation is going to come lower, but it's not going to be at 2% anytime soon. And how does the Fed, when we're casting an eye, even further out into 2023 and so forth, what does that look like? And that'll be a situation in which it's very hard to see energy prices and food prices really coming that far down. You have OPEC meeting next week. They've been very stingy with their supply reintroduction onto global markets. They've been falling behind their own production targets and doing nothing to make that up among the producers that actually have headroom to do so, like Saudi Arabia. The Biden administration is continuing to outreach to Saudi Arabia and energy producers, Venezuela among them. This is a very big change. It's indicative of just how persistent they see this problem being. And the thing about high inflation, it is, we've had kind of this shock, but the sense of it going forward, is this something like body blows to a boxer where the US consumer is kind of covering up? They've got good defense, but they just keep getting hits to the body. And by next year, is the state of the consumer's finances, just kind of all tired out? And that's, in a persistent inflationary or persistent supply shock dynamic in those energy and food categories that just keep hitting the consumer.
I think that's going to be the story for a while here, just sorting through that. What do we have to look ahead to in the next week?
Jobs.
Do you have a prediction, Brendan?
So unemployment claims have been peaking up a little bit. It's still in the 210 to 220,000 range, and we have had some announcements of big companies slowing, but I don't think we're anywhere near negative numbers. I think we're in that probably back to what we normally should be hiring, in the 200 to 400,000 range.
Do you think people will be disappointed? Do you think people would be disappointed if if those numbers start coming down into the 200,000s instead of the average of 400 plus thousand that we've been seeing?
It's actually probably bullish for the market, because then the Fed, one of the worries is the Fed over tightens because the labor market is so hot.
Yeah, I agree. It's a Goldilocks number. If you sort of dip down into the 200s, that's still really strong, but it's not as inflationary as like a 400. And it's not dismal like under 100,000. So that, I think, would be a Goldilocks number. Dennis DeBuscher last week highlighted the fact that good news can be bad news in this environment. If the economy keeps ticking higher and the consumer stays powerful, the Fed is just going to have to get more aggressive. And we've sort of linked that same kind of narrative with the stock market. If stock market keeps going up, the Fed's going to do more. Well, the stock market's come down a lot, so I don't think the Fed is necessarily all that freaked out if you get a little counter trend rebound here in the second half of the year. Yeah,
I think that's right. I mean, that is like the paradox for this period that we're going to be in for a while is good news, bad news, good news. So, John Dick, plans for the weekend?
Lots of cased meats, grilling, bonfires, the whole outdoors. Yes. Can't wait.
I made my IMAX. I bought my IMAX ticket for Top Gun Maverick.
Yeah, I'm going on Thursday. It looks
Nice.
amazing.
Yeah,
The reviews of that movie are unbelievably good. Like I'm blown away by it. I mean,
it's going to be a
almost like
blowout.
it's almost like they spent $1 billion seeding all of those reviews because
John. Well, I think they did, John. I kind of just asked that question on Twitter this morning, like what the marketing budget is for Maverick, and it's got to be off the charts. Because now, let's be clear. I am in the target demo, so I should be seeing it everywhere I look. But I am, in fact, seeing it everywhere I look. Like they're leaving no stone unturned in making sure that I get to the theater to see it. But I'll tell you, I went just looking through, I want to see it in IMAX, so I didn't check the other screens. But I mean, I couldn't get a decent seat until Sunday, and so the theaters are going to be full for it this weekend, no question about it.
I saw this guy on Twitter
from a political perspective, this is perfect for the Biden administration. It's like the late 70s when the U.S. beat the Russians, and high inflation, America sucks, and it was like, and then USA, we needed a good, hardcore pro-American movie to be proud about.
Yeah, I saw a guy on Twitter saying he was going to buy Lockheed Martin stock a couple of weeks ahead of the release of Top Gun. It's probably going to work out.
Well, I'll share my review of it after the show. But I no matter what, it's going to be great. I don't even care. It's going to be great.
Yeah. Are you going to go to one of the fancy movie theaters that you can relax and have dinner and have a drink?
No. I'm not in it. I just like, I want popcorn and I want soda. Like
and a huge screen.
I'm in a giant screen. I want a big screen. I like 3D. I like IMAX. If you're going to go to see a movie these days, especially what we're all going to see in movies these days are big movies.
Yes, exactly.
Like, that's what's drawing people in. And I do like to go see big movies. I like to see small movies too when they're available, and there just aren't many available. But big movies are available, and they're great to see in IMAX. And I think that's the premium movie experience that we're going to be. That's the future, I think, for movies. It has to be a premium experience because we do like to see movies with other people.
I agree.
Yeah, but it's got to be a good experience. All right, guys, have a fantastic holiday weekend. Remember all those we've lost, especially this week. It's a very incredibly sad couple weeks with the events in Buffalo and Texas. Keep all those lost in mind, and your family and loved ones. Have a wonderful Memorial Day weekend. We'll see you next week on the Macrocast.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.